Hello and welcome to Focal W23, our 7th edition. I'm Tawas and this is my co-founder Hector. Thanks to our partner VCs, our amazing applicants, and you, our Demo Day attendees, Focal is now one of the world's largest startup demo days. This time out, we're welcoming dozens of new VCs, such as Cherry Ventures, Point9, Bessemer, EQT, Stage 2 Capital, Credo, and many more, to our now 200-strong VC partner network.
And it's not just world-class VCs who are putting their faith in Focal. Over the next couple of hours, you will see 30 of the world's most exciting pre-seed to Series A startups pitch, chosen by VCs as the top 1% out of an extraordinary 1,900 applicants. As has been the case at every demo day so far, this is a record-breaking number.
Focal is fast becoming the beating heart of the early stage fundraising process, initially achieved by pooling every VC you'd want to know in one place, which has correspondingly attracted world-class pre-seed to Series A startups. Previous finalists have gone on to raise over £110 million and become a force to be reckoned with in their respective verticals, with our first exit in W21 finalist Supersheets. That's not to mention the thousands of brilliant companies which didn't make it to Demo Day. Our VC partners have now backed dozens of Focal finalists, and our angel community has joined the Focal team in investing close to £800,000 in some awesome companies, with the likes of Soma Capital, Google Ventures, 20VC, MMC, Eco, Norsken, Ada Ventures, DMG Ventures, Concept Ventures, the list goes on.
We're continuing to offer attendees the opportunity to invest alongside us after Demo Day, and an exciting new development is that we're launching off-cycle SPVs, which will allow any of you to invest in startups via Focal throughout the year. But please do remember, if you do this, your capital will be at risk. To receive information on our SPVs, please visit gofocal.vc/SPV or fill out the form in the chat on the right to join this list. If you don't fill out the form, I'm afraid you won't receive our deal flow. Of course, this wouldn't have been possible without our fantastic sponsors who enable us on our journey to do away with the old corridors of power, providing an equal playing field for all founders and funders. All of our sponsors are an absolute pleasure to work with, and I really do mean that. In addition to our old friends and industry giants, HSBC Innovation Banking, Google Cloud, Mishcon de Raya, one of the leading law firms in the startup world, and BDO, we have Stripe and Rippling joining us. With this amazing group, we can support our applicants in many of the key areas of startup building. I'm now going to hand over to the rest of the team, and on that note, I'm delighted to announce Focal's second full-time team member, Izzy. Izzy, over to you.
Hi, I'm Izzy, and I've recently joined Focal as operations lead. Before joining Hector, Tawas and Jack, I spent 1.5 years at a prop tech startup called Coca as the first employee in the country, helping to build out the UK team. And prior to that, I worked in tax, advising multinationals on their group structures at BDO, who I'm also happy to see sponsoring my first event here. On the side, I've long been passionate about fostering communities. I was on the founding team at Embark, a community for aspiring startup founders, which received backing from Notion Capital. Currently, I'm collaborating with my friends at Jumpstart to create a community specifically tailored for women in the startup sphere. If you haven't been able to tell already, I love the power of community. With over 200 VC partners, a thriving portfolio of startups, and the support of fantastic corporate sponsors, Focal represents my most exciting community endeavour so far. I'm looking forward to expanding our current range of Focal events and initiatives, including our upcoming GPLP Demo Day, and helping our partners unlock even more value from our ecosystem.
Welcome, Izzy. We're seriously lucky to have you. With the fundraising climate now as tough as ever, we've been scratching our heads to see how we can improve our existing model and build Focal at the epicenter of the VC ecosystem. Now, raising funding as a founder is hard enough, but for budding VCs trying to raise their first few funds, the slow market has made their job even more challenging. Neither limited partners nor fund managers enjoy the process. It's incredibly opaque and solely relationship driven. with limited information exchange between both parties. That's why we're launching Focal Deploy, a demo day for limited partners to find their next fund manager, and for GPs to easily find great LPs. Like our flagship Startup Demo Day, Deploy is built from within. In this case, by LPs and VCs, for LPs and VCs, both passionate about leveling the playing field for both established and emerging managers. We've also been lucky enough to engage a handful of top-tier limited partners to help us along the way. We're currently accepting applications from limited partners and pre-registrations for GPs wanting to take part. Please check both out at gofocal.vc/LP.
Exciting stuff. Thanks, Jack. We see this as another big step towards tying the whole ecosystem together. Now, we want to talk about today's demo day. It will run as follows. We'll kick off with our panel, before then moving on to the first half of pitches from our finalists before a 5-minute break. We'll then have the remainder of the pitches, and finally, you can drop into founder sessions hosted by some of our VC partners, where you can hear more about each of our amazing finalists. After the event, we'll send out a snap poll to see which startups piqued your interest.
As mentioned, we'll also be giving attendees the opportunity to invest through SPVs from as little as £1,000 once startups have a lead VC for their round. In order to see details of these in the coming weeks and months, register your info at gofocal.vc/SPV. Again, I'd recommend you do that now by clicking on the link in the chat on the right. This is a great opportunity to invest in the very best pre-seed to Series A stage startups as chosen by around 200 VC funds. But do remember, if you do this, your capital is at risk. Now, without further ado, we are very lucky to welcome some of the brightest minds and biggest names in the industry to discuss the state of fundraising. Our panelists are Saranga, general partner at Balderton, having founded unicorn Blinks in the early 2000s, Carmen, the founder of Coco Ventures, Hussein, the founding partner at Hoxton Ventures, and Fred, founding partner GP at Stride VC. Enjoy the panel.
So hello everyone and welcome to the Focal W23 Demo Day panel. We're going to be discussing the state of fundraising at the moment, and as a platform designed to make fundraising more efficient and more accessible, this really is a topic that's pretty close to our hearts. It's been a very tough 18 months for many founders, many investors as well. 2021-22 was a crazy time. Lots of huge rounds, an abundance of cash. Startups able to raise very easily, pretty much no matter how well they were doing. And times have changed. So I think it's going to be interesting for our audience to hear the impact of this on both startups and investors, and how they can kind of adapt moving forwards. So we've assembled this group of some of the smartest minds and the biggest names in VC in Europe to chip in with all their thoughts. So we hope everyone's going to learn lots. And without further ado, I would like to ask each of the panelists to give a quick introduction to themselves. Perhaps we could start with Saranga.
Yeah, sure. Hi. It's great to be here. Thank you for having me and the rest of us. So I'm a VC at Balderton Capital. We're an early stage and now late stage as well, pan-European venture investor. We've been around for about 22, 23 years, backing tech companies across the continent, from the UK all the way to Greece and beyond. My background personally is originally technical, so I have a computer science degree. I was a software engineer for a long time. Then I moved to California, to San Francisco, and while I was there, I was a founder and CEO of a company called Blinks, which I built over about a decade and ultimately took public. And after that, decided I wanted to move back to Europe and became an investor. It's great to be here. Thanks again.
Thank you. Carmen?
Hi, everybody. Super nice to be here. Thanks for having me. I'm Carmen, founder of Cocoa. At Cocoa, we say we're VCs turned angels that become your in-house VC. Basically, what that means is we're VCs for a long time in large funds, and also we're angel investing on the side. And then this realized that there was a gap in the market to actually invest like an angel, but bring on all the VC expertise and network. And so that's what we do. We write 250 to 500K checks, depending on the size of the round. Whole point, no friction allocation, and we don't compete, we collaborate. So I'm very lucky to get to work with everybody here in the room. And to that angel check, angel stake, we bring our VC network and our VC expertise to support founders as in-house VC and help them hack the system. So that's very much Cocoa, called Cocoa because Cocoa is the seed of chocolate. And from the cocoa beans to a chocolate bar, you've got many stages, like in the life of a startup. And we love chocolate and gift chocolate. And now, me personally, just very quickly, I actually started my career in politics, came to London to serve my time at Morgan Stanley, joined VC 8 years ago from Morgan Stanley because I thought it would make me a better founder. And actually, I started a company, bootstrapped it from my living room here in London just to realize I missed investing a lot and was an investor at heart. And since then, that's all I can imagine doing.
Great to have you here, Carmen. Hussein.
Yeah, I'm Hussein. I'm a partner at an early stage venture fund called Hoxton. We are 10 years old now. We're a seed and pre-seed firm. I started off my career building products back in the Bay Area and then switched over to becoming an investor, I think like 15 years later, after a couple of stints of big companies, and then flunked out of a big venture fund. And then set up a small venture fund and have yet to flunk out of that, even though I've flunked out of pretty much everything else.
Fantastic. And Fred?
So I'm Fred Destin, founder of Stride. I started 5 years ago. I started the firm because I wanted to ground my relationship with founders in trust. From trust, we can talk about truth. So that was the founding principle. We only do seed investing. We're very small, boutique-y, hands-on, very few high conviction investments, and we spend significant time with our founders. And, I've been in venture since 99. I still love it. I adore working with founders. It gets me up in the morning, and I was a past investor in companies like in the UK, Zoopla, Deliveroo, Secret Escapes, PillPack, Integral Ads in the US, and a bunch of others. So, still here, still absolutely adore my job.
That's great. Thank you so much to you all for joining us. Hector and I are honestly thrilled that we can have this conversation with you all. So we're keen to crack on with the questions. And Hussein, I want to come to you first. So you've been, as you touched on, at the top of European venture for nearly 20 years, and you had a fruitful career in Silicon Valley prior to that. And so you bring quite a unique perspective to this conversation. Do you think the state of the fundraising landscape in general is as grim as it's perceived to be right now?
I think in Europe it's still pretty bad. Now, I generally speaking, at a high level, I think what happens in the Bay Area, it takes like 6 months for the news to kind of trickle over to this side of the pond. And last year in 2022, I think things slowed down dramatically in the US, and you can see it in the public markets, right? If you're a late stage investor, much more closely aligned with the public markets, that kind of slowed down first. And it kind of went all the way down. It never really stopped at the seed stage side, but everywhere else, like Series A and above, I think was pretty slow. And then I think Europe then followed suit. I think Europe got the memo like 6 months too late compared to the US, but then people started following suit here. I think I'm like in the last like 3-ish type months, I'm starting to see glimmers of life emerge back in the US. So the financing market there is not as dry as it was like say 9 months ago at the Series A and Series B stage. And then obviously all this stuff in seed, I think, has been reasonably shielded. And all this stuff in these new hot sectors like generative AI have been like super protected. I mean, the rules basically don't apply. It's the same rules as in 2021. But I think the European market is still 6 months behind, and it will probably take until like January before Europe gets the same memo that the Americans are investing again. And so maybe they should be investing too.
Okay, that makes sense. Does anyone else want to chip in on that?
No, I think that's true. Obviously, the interesting opportunities for European companies, but that are either in a sector or of a scale that attracts US funding directly. So I think that those sorts of companies perhaps are already seeing a bit of a change in sentiment. But I think Hussein's right. The vast majority of our peers are still fairly quiet, but there are some notable exceptions. So it's definitely changing, but it's also clearly a few months behind.
Okay. And why are people holding off? Why were people holding off? Do you think there was a real dip as as there was fear in the market, people kind of latch onto a worst case scenario in their heads, and then they start to see some stability or build some confidence back up in the future, and so start deploying again. Is that kind of the cause, or is there something deeper than that?
I would jump on that one. I think there's a bunch of factors that come together in unison. One of the big ones was the speed of deployment in the prior years. So, people got out of the gate extremely fast with their funds, invested at pretty high speed, and then you end up with a glut of companies in your portfolio who come back for funding at the same time, who are all struggling. And, your LPs, you have to go back to your LPs and explain why you deployed your fund in a year and a half instead of 3. And, I think that kind of LP-GP dynamic is a big part of why people just slowed down dramatically. The other thing is when you have no visibility, uncertainty kills decision-making. So if the situation is going to be bad, if it's good, you can make decisions. If you don't know what the hell it's going to look like, people tend to stay on the sidelines, just wait for some clarity of direction. And I think the markets were so volatile that a lot of people just said, we're just going to wait this out for a couple of quarters. There's no rush in deployment. We're not going to get shot for not deploying. So let's just hold. And so I think there was a lot of waiting for clarity. And, like I said, that kills decision-making like nothing else.
Mm-hmm. That makes Carmen, sense. It looked like you had something to say as well.
Yeah, no, I was exactly going to say about uncertainty, right? It basically removed the incentive to deploy, because also the opportunity cost of deploying suddenly became much higher. Because it could be that if there was a correction coming, you were going to pay 30% or 40%. And I think that to Fred's point is spot on. If we know we're in a good place, if we know we've touched rock bottom, we can invest. We invest 10, 12 years from now, right? In outcomes 10, 12 years from now. So obviously they are impacted by the economy, but they're not just we can take a long-term view, but the problem is when you don't know what's going to happen and when you're just waiting to see if things get worse, if things improve. So I agree, uncertainty totally kills decision. It paralyzes basically decision-making.
I'd push back and have a slightly different take on this. I think generally speaking, I think our market is monkey see, monkey do. And when you see everyone else sitting on the sidelines, you kind of follow suit. And the last 10 years has been a momentum market where every monkey made money. It didn't make a difference what the heck you were doing. 80% of your seed investments went on to go raise Series A, went on to Series B. Whether these companies were intrinsically valuable or not, nobody really cared because the music was playing and everyone was dancing around. I think when the music stopped, I think people got really timid, and then they saw everyone else around themselves get timid, and the music just all abruptly stops. There's a famous academic paper, which I don't think is particularly well read, but it was basically what's the behavior of rational investors in irrational markets? And technically, you're supposed to short the market, right? You're supposed to go the opposite way when the market is behaving irrationally. And if you look at hedge fund performance in 1999, 1998, the peak years of the dot-com bubble, almost every single smart hedge fund rode the market up. They didn't do the opposite. There was only one famous hedge fund, ironically, that went against the market, which was Tiger, and Tiger Capital Management shut down, right? Tiger Global is a Tiger Cub. It's not the same Tiger of the 90s. So there's a huge incentive to just go with the flow. And when the flow goes out, we're investing for 10, 12 years. So who the hell cares what the flow is today or tomorrow? We're talking about 10 years from now. But I guess when you're the only one left doing it, it's much harder. It's much harder to get these companies financed because you have to look to other people to write the next check and the check after. And so you just you end up going into this pause, and the market builds, it's like a wave, right? It kind of builds upon itself and it becomes really uncontrollable because everyone goes with the wave.
I think that's super interesting because there is some sort of kind of tension or conflict. I do agree with you. This is a herd mentality kind of. But on the other hand, we also know that you make money when you stand higher chance to make money if you go against the market. If everybody does exactly the same, there's less room for it's this kind of idea of contrarian but right, which is so hard to take. I do think though that a factor of this that the issue with the situation that we had, at least in Europe, is the valuations, I'm speaking pre-seed, that is what I actually know, didn't actually correct that much. So when you think about like the market backdrop, that there was uncertainty, we didn't know, and then valuations that were not really correcting. In fact, in pre-seed and seed, they were actually like compressing, so the risk-adjusted return didn't really work. It was like, well, how do I find my incentive to invest when like it's, I think like it's a mix of everything. I do agree that people like, and Fred mentioned a little bit when he said like, you're not going to get shot for not deploying because nobody is deploying, and that will find some comfort in there. But I honestly also think like it was very hard to find an incentive to invest because the market backdrop is so uncertain, and valuations, I mean, we're still, I don't know how what you're seeing, but I'm surprised this side of the summer, a lot of the rounds I am looking at are 3.5 to 5 million pre-seed, pre-everything, and some are AI, but others are not even AI, at like 15 million post. When you actually have the seed average at 15 million, those are pre-seed. Like the risk-adjusted return to invest at pre-seed is really not there because the next round is not going to be at 2 to 3x. And you will have 18 more months and much more like information, 18 more months of information. So I think that it was a combination of many things, and that in Europe the correction in valuations wasn't such to actually justify incentives to invest in a market that was not very alluring.
Especially when there was a risk-free rate that's much higher than it was a year and a half ago, right? I was just going to say one very quick, very prosaic thing as well is people were busy. When that sort of change in the market happened, anyone who had a substantial portfolio was immediately in firefighting mode across that portfolio. Some companies, we're all early stage venture investors, so unfortunately some of the companies we back don't make it. That's part of what we do. It's part of what the founders do and sign up to. But unfortunately, you also get a lot of great companies that get hit unfairly in a market like this. And I'm sure all of us, certainly I was very busy looking at those companies and figuring out what the path to success was. Do you have to cut costs? Can we raise money from an unusual source, et cetera, and all of that takes time. So I think for some people, they were just busy. And the busier you are, the less time you have to look at new things.
Yeah, very good.
The other dynamic that I'd add to all of that, which for me has propagated uncertainty and the herd mentality, is the relative immaturity of the European VC ecosystem. The vast majority of VCs in Europe have simply not seen a down cycle before, and they didn't know how to react. And I think a lot of people waited to see what the impact of it actually was. Like Hector and I were in education last time we had a financial crisis. So there has been a big learning curve, I think, for a lot of VCs in Europe as well.
We got quite a crash course with SVB and the crisis. We got quite a crash course, all of us, in the past year. But yeah, that's right. I think that goes back to Hussein's point on Europe taking 6 months longer to also adapt. It's also a matter of the lack of maturity of the ecosystem versus the US one, probably.
Very interesting. Lots to chew on there. Fred, just wanting to hear some of your thoughts. So, I mean, it'd be remiss of us not to mention Gen AI. It's what everyone's been talking about. And it's, without focusing too much on Gen AI, but think of it more as one of many trends and hyped up markets that we've seen in VC over the years. There are going to be many more hyped up and trend markets. And I wonder how VCs can manage this sort of trade-off, this challenge where you don't want to miss these nascent markets where there's huge opportunity and there are great companies being built. But you also don't want to pay huge valuations where there's no real upside. So how do you balance that dynamic?
Look, my first comment is that no two hype cycles are the same. So, commenting about it at a meta level is not actually that useful. If you look at crypto, what was striking about crypto is, of course, it's a foundational innovation that may still yield and probably will still yield over time. So it's the classic, once you pass the hype cycle, you start to see the benefits over the long term. What was weird about that one is, of course, you had a lot of serpents eating their tails, where coins were themselves the engine of growth of the companies that was promoting the coin. I mean, there was a lot in there that was either grifting or not even suspension of disbelief, but suspension of thinking. That I remember, if you remember those people who were selling retail investment products based on staking, I mean, it's completely insane, right? So when you look at AI, I think it's quite a different animal. First of all, because it is the endpoint of a very long trend that we've seen. So from big data to machine learning to now artificial intelligence, this has been a long oncoming trend of how we harness data and go beyond human capabilities. So the reason why people are excited is because it does transform absolutely everything. Now, VCs love hype cycles partly because they're engines for disruption, partly because there's something to talk to LPs about. But I think this one, if you believe Mustafa Suleiman and we're going to see 1000x improvements way faster than Moore's Law over the coming years, God knows where this thing is taking us, and it seems to impact absolutely every area of our lives and the way we work and the way we produce content and everything else. So when you're faced with hype cycles and momentum markets, there's no stepping away from first principles. And so if you look at the moment, people are focused either on these foundational models that raise very large rounds like Mistral, or they're sort of derisive of thin layer Gen AI companies that sit on top of the LLMs and have no real sustainable value. Now, if you dig underneath that and you go a little bit more vertical and go back to first principles, there's a lot of really exciting stuff happening. We have a company in the portfolio called TechWolf that abstracts skills and talent information out of operational systems. They're not in the line of fires of LLMs. It's, fundamentally interesting. And you kind of want to go back and look through the bullshit and the hype and just see, do I have sustainable competitive advantage? Is this a fundamentally interesting insight? Can you scale it at venture speed? And just hold your nerve and just go look for this real value. The problem is when things get vastly overpriced, effectively people de-risk, kind of assume there's no risk in investment anymore. There's no real way to win in that. So this is why I like being at seed, because we don't have that much valuation inflation on these companies, and it's kind of a relatively healthy place to be if you pick your bets well. It gets somewhat terrifying when you look at Series A and B and the prices go out of control and you're like, how the fuck are you supposed to make money on that? Mm-hmm. And I think, these hype cycles are consistently damaging. But anyway, I think my key point is, hype cycles are indicators of fundamental change. And, you work your way through the hype to find the real value, and you create generational companies or fund returners, etc. If you're able to navigate through that. So I think we have to, in a way, we embrace hype cycles because they are carrying change and carrying opportunity, and we're just trying to navigate to real sustainable opportunities within that, which is not easy to do. So there's no substitute, I think, for going deep, for going back to first principles, for staying highly disciplined. And it's just hard to do when markets run away from you, but I think that is the game.
I mean, do you think there's some chance that we'll go through the next stage of the hype cycle with AI, where it will hit a lull? Because yes, there are some high value use cases for AI today, but there's a tendency among investors to think, oh well, okay, because we've seen some AI companies work in certain use cases, it's useful in every use case and works 100%. Where actually it works, many use cases, for example, high trust areas. The 95% accuracy that Gen AI can get to is simply not good enough because the 5% that end up being costly mistakes. And so for certain use cases, it's just not there yet. And perhaps, I'm sure smart investors are thinking about this, but is there a risk that the market becomes inflated or is inflated at the moment and that we will still hit a lull of some kind?
So let me pick that one before I open up to the group. So I think AI for me comes with specific challenges. One is the capacity for adoption by existing players is much higher than before. So, before you think you're going to disrupt X, Y, or Z, their capacity to internalize AI in a bunch of functions is very high because of the compute fabrics we have, no-code interfaces, blah, 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 and the speed at which they can develop and deploy. And so I think the ability to disrupt incumbents is quite a bit lower, number one. Number two, there's too many point solutions. You kind of have to take whole workflow problems and go and attack them and see where AI is meaningfully transformative to the use cases that you're trying to go after. And then number three, of course, is we know that the big boys are accruing a lot of the value in the technology tools. And so it is hard to see how much white space you have with the speed at which they're moving, investing in each other, internalizing these technologies. So I think it comes with a specific set of issues that we have to navigate that maybe weren't the case before. Whereas before there was a next DNA evolution curve, and you just assumed that the existing code base could be thrown away and you would outcompete the incumbent. I don't think that's the case today. So it comes with a bunch of challenges like that, which I think make it harder to navigate. On the flip side, the size of the opportunity, I think unlike crypto, the use cases are evident and they're everywhere. So I think the big difference is it is absolutely freaking transformational to everything from building websites to, whatever use case you want to throw at it. So I don't think the end point, where you're going to deploy it, is in question. It's just can you carve a path for yourself that's good?
And Saranga, what's your view on this as a slightly later stage investor, where you're investing in companies that have normally some considerable traction and therefore have proven themselves to be solving real pain points for companies? Are you comfortable with investing at inflated valuations compared to a perhaps non-AI augmented startup?
Yeah, so we've done both. We've invested in some things that are at sort of seed stage, probably not pre-seed, and then we've also invested in things that are later stage than that, all the way up to about Series B, I think, to be fair. And I guess we're very comfortable with this. We've been investing in AI, or the predecessors of AI, that Fred sort of outlined that really well, for certainly all the time that I've been at Balderton, which is about 10 years. And so we've seen that evolution occur. And while it's difficult to predict exactly when certain switches will happen in technical capability, I don't think it was that big a surprise that one was going to come eventually. And the exact timing of it and the nature of it, of course, is always quite exciting to see. But so for all those reasons, we were certainly ready to invest in this sort of area. And when we saw some of the companies and what they're capable of doing, then I think we got very excited about the opportunity to invest in them. I don't think the valuations are necessarily inflated compared to what they can one day be. They are certainly higher than other sectors of the market right now, although not every sector of the market. But the reason for that is because the opportunity is also very commensurately large. I do think that Fred's right, that it is harder to make investments in companies like these the later stage you go. The size of the investment just becomes extremely large. The proximity to some kind of outcome becomes shorter, and so there's a lot more on you to get this right, to get the valuation right. And I think that's part of what's driven us to invest on the early end of the spectrum from our point of view. But once we've been through a bit more of this cycle, I think we will understand what the ultimate values of these companies are. And at that point, people will get more comfortable investing later and later. So I think it's a real thing. I remember studying computer science 25 years ago when I was an undergrad, and I remember the AI course extremely well. At that time, it was kind of a crackpot thing that no one serious did. In fact, if you called your company an AI company, generally people laughed at you. And I remember at the time that there was a lot of theory on how powerful this could be, but there simply wasn't the algorithmic and in particular physical compute power to pull that off. And that's what we've seen over the last 25 years. That has just, as always with Moore's law, just increased and increased. And at some point it becomes reality, and that's exactly what it's doing. And actually the outcomes and implications of that are not that surprising to anyone who studied computer science 25 or even 35 years ago. It's just that we finally caught up with that, which again, at the time seemed impossibly far in the future, but that's the cool thing about the industry we work in, right? Stuff that seems impossibly far in the future is sometimes not that far at all.
From a deal economics point of view, at some point I'd love to pick your brains on how these outlier mega rounds come about and how VCs underwrite those. But I want to move on to Carmen with another question. Carmen, it's been a bit of a baptism of fire building Coco in over the last 18 months. I'm intrigued to know what you've learned during that period of time and how that's affected your approach to investing moving forwards.
100%. Actually, we raised Coco October, November 2021. So the peak of the market. And we started deploying in January 2022, which was when things started to I think I've learned many, many things. Coco is both the joy of my life and the hardest thing I've ever done. And every day is like a big learning. But if I should summarize in one thing, I've learned that money has a cost. I think at least I grew up in a world in which capital was free almost. Rangat spoke about interest rates before. They were like negative, right? And that created a lot of behaviors that we've discussed now, that we've all gone through. And I think when you realize that capital has a cost, it does change the investment framework. It does change the way that also companies need to be built. At the end of the day, if you think about it, now you can make 5-6% on T-bills with no risk and literally liquidity, like immediate liquidity. And we as funds are asking investors to give us money for 10, 12, up to 14 years with massive risk and zero liquidity. The returns that we are now expected to give in order to compete with other assets are have multiplied by an order of magnitude. Same applies to the companies. Likewise, right? In asset allocation, you could do T-bills at 6%. I mean, we have we funds have the money of the fund in a current account giving us or saving accounts, I don't know how you say that in English, giving us 4.8%, right? So as a company asking an investor to give you money with risk, absolute risk, and for 10 years, the returns that you need to provide are much, much higher, right? And so I think that the whole idea around being more disciplined on that capital efficiency and really understanding the economics of a model, not just the fact that, there are models that just don't work. And so actually I learned a lot around that. I now look for founders, I call them killers with a heart, solving business problems, because we need to solve business pain points, and where there's no structural impediment to build a big business. Because there are unit economics that it doesn't matter what kind of founder you are, they just don't work. If you make €2 per revenue per user, and you need to pay for acquisition, it just doesn't work, right? Or 3% margins, negative contribution margin. So all these things, I think we got a little bit, it suddenly we had a reality crash course on. I think though that when it comes down to valuations and how do we as investors think of valuations, I think that I always tell founders, do not focus a lot on top line valuation, because that's a very confusing concept. That's very hard to compare across the board. So if you think about it, you can raise 3 million at 30 and you have given up 10% of your company, which is on the very low range. You can raise 10 million at 30 and you've given up 30% of your company, and it's still 30 million valuation, right? So I think that this idea of just thinking about a lot more about money that the business needs plus a buffer, because it is a world where capital has a cost and is scarce, and optimize for your dilution for sure. And think of pipeline valuation just as a product of those two, of the size of the fund and the dilution, and just think about the concept of how much pressure does this top line valuation put on me given the milestones I need to fulfill to grow into it, is kind of a framework to think about kind of this new funding landscape that can be helpful. After all, I always tell founders when I'm acting as in-house VC is for founders who have lots of options, think about how much money the business needs, raise that plus a buffer, and be very capital efficient. And for founders who are struggling, or many, raise as much as you can. We all do what we can with what we have. So but yeah, that's basically a little bit key learning and how I try to operate when I help founders as in-house VC.
Fantastic. Thank you for the insight. Moving on slightly, I think there was a market in particularly 21-22 which favoured founders who were great salespeople, and I'm open to being challenged on this, but it was a market where founders who could build momentum for the round, build FOMO, had an unfair advantage in raising these big rounds. And I wonder whether VCs are still looking for these kinds of founders who credit to them, they can persuade others to join their company, to invest in them, convince others to quit their job and join. Or is there actually a move, is there a change in sentiment of VCs looking for something else in founders now?
My take is, Yeah, I'll go because and my take is, generally speaking, like the role of a founder is like very multifaceted, right? Like you're building a business, but you're also, because you're such a fragile young business, you're also in the business of raising capital, and you have to be equally good at kind of sort of both. You know, the job of most like CEOs inside of bigger companies is like set the direction for the company, hire the right people, and make sure there's a strong enough balance sheet, right? It kind of boils down to those three things. If you get all those three things right, like the company's in a position to be able to, you know, to do well. For a founder, it's like the balance sheet is the raising of the money. I think if you take away that skill set, so you take away the charismatic, you know, sales-oriented founder, and they can't raise the capital that they need, then I think it's really hard to get the business to lift off, because like these are fragile young businesses that are dependent in many ways on the venture cash that's going in. I think the bigger indictment of the last few years was everyone forgot about the other bit. Like people focused on the capital raising bit, but there's the other bit, which is setting the right direction, building the team, and like actually building a business, right? Like I think we saw the same behavior. To me, this is like no different, having lived through the dot-com bubble. It was almost identical to what happened in the dot-com bubble, which is the last time when money was free, like as interest rates were heading on a downward spiral then as well. Everything got funded. You know, people believed that, you know, growth would kind of solve all ills, and the mechanisms for like unit economics would come in time. And like a famous chart by Frank Quattrone, who's like one of the leading investment bankers like for the tech industry. You know, it says like as you go through this like exuberant period, you go from like measuring multiples on EBITDA to measuring multiples on revenue to measuring multiples on page view to measuring multiples on users. It becomes like more and more fuzzy, right? Because like you can defer because each one is kind of sort of a proxy for the other, and you can forget about the actual underlying economics of the business because capital will get thrown at you and you'll figure it out in due course. And I think the challenge is sometimes due course arrives and sometimes it doesn't. And the same kind of bad behavior that you saw in the dot-com bubble, where people were like trading at insane multiples and then going off and acquiring businesses at really low multiples and then tacking them on, like you saw with Baidu, you saw with Hopin, right? Like, so you're trading at an inflated multiple, so you're basically buying revenue, and like, you know, someone's paying you 20 times revenue, so you're going buying revenue at 1x, and kind of convincing people that an offline business is equivalent to an online business, and everyone kind of suspends disbelief. Like you saw that same crazy stuff in the dot-com era.
I think what's very interesting. Sorry, I think what's very interesting is that when capital was flowing free, I think a lot of founders like flipped the framework, and suddenly they were building a business to raise money almost, rather than raising money to build a business. And I think it is very.
They're still doing that. The overwhelming majority of founders are like heavily optimized, like their businesses for like, what's my next fundraise? Who is it from? What's the size of the round? Versus like, how do I make a crap ton of money?
How do I build a business? I agree. And I think that I understand that like being a founder is very like, and it's a lonely place and it's a difficult, you're like in the middle of a storm, you need to set direction. You don't know whether you're right, wrong, and rounds can be like a useful validation mechanism. So there is this temptation or this gravity towards like optimizing for them. But at the end of the day, you need to build a business, right? And I think that I agree, many founders just still like struggle with. And the other thing I think was useful learning, and actually from today's world the same, is like I look for, so many spaces are becoming so competitive, right? Because we have in Europe now this situation in which we have a certain amount of scale-ups, and there are operators that have like kind of grown up in these scale-ups, have seen scale. Now they decide it's their turn to be founders. One, because they want to. Two, because now it's also not so much fun to be in those scale-ups anymore because it's not growth, it's like optimizing. And they get there and they kind of like also forget, like, or like they basically, it's very hard to get original ideas. So everybody is tending towards the same spaces, right? There are certain spaces, and I don't need to name any, but sales stack, customer support, legal copilots, like we're like, they're literally like popping up like crazy because there's no barrier of entry. There's no almost expertise needed, specific industry expertise needed to build those. I personally am tending much towards, and it doesn't need to be a technical skill, but to counterbalance this point on sales that you made. But yes, something that requires some insider knowledge, some unique insights that are going to be a barrier of entry for other potential teams and great operators that can just come in. Because the challenge today is there's so much money in the market. These amazing operators are all going to get back. And if you're in one of those spaces where they're so competitive, it's so hard to make money there as well. So I try to feel almost defensible, space tech. You can be the C-level of a tech scale up and you can't go into space tech if you don't know space tech. Or we have AI applied to steel making. Likewise, I try to find some sort of defensibility in team expertise and unique insights, because if not, it's so difficult. The quality of operators is much greater. There's so much capital. And so that's another one.
So I kind of want to bring a slightly different lens to this. I don't disagree with what's been said, but I would say compared to the bubble, so my experience of founders in the last few years is they're actually pretty grounded. I think they were looking at their business mechanics from the beginning. They're looking at, whatever ACVs, CACs, I've worked, the majority of founders I've worked with were pretty grounded in the reality of their business. Part of the difficulty is when you're trying to grow super fast, it is extremely difficult. It's like you hire people, they hire more people, it gets out of control. It's like entropy gets at you. And so before you know it, you've built a monster that's harder and harder to manage, and you don't see where your capital's flowing, and you start to lose sight. And I think for me, actually the venture industry has got a pretty major responsibility in driving that behavior, because we were telling people, hey, if you're not growing 5x, you're not growing fast enough. If you're not, so you kind of get on that treadmill where you're like, you want to justify high valuations. The VCs are expecting to see high growth from you, and now we're in this dance, which is a collective hallucination where we're going to be able to grow at no matter what speed and be capital efficient in the process, which of course nobody can do. And so my view is founders very often, instead of staying in control of their company and how they're growing it, were listening to the sirens of venture capital and going to play a game that wasn't their own game. And my advice to people in general right now is hey, this is your company. I have a portfolio, thank God. This is your company. You only have one shot. Run it the way you want to run it. And some of the venture advice I've heard is absolutely terrible. You have companies that are not growing super fast, but they're doing okay. They have a path to profitability, and then venture investors come in and go hey, why don't we do an extension round towards the next round? And, we're just going to get you on a growth path. And you kind of go, well, the sales mechanics aren't fixed. They're not ready. And I think very often, it is a dance. And I think that we have to adjust. We also have to give, in a way, power back to the founders to say, the problem of capital intensity from beginning to end and where you exit is fundamentally your problem. We want to empower you to think about the amount of dilution you're going to take along the way, not listen to the siren songs of capital, but just build it in the way that is right. Because I think very often they actually know if you kind of allow them to go back to basics and to respect the speed at which they're able to grow. Because, we have done unnatural things in terms of the speed of growth we're trying to put inside our companies, the speed of hiring, speed of execution, blah, blah, blah. And then you end up vaporizing capital because very few people on the planet can manage that level of scale up and complexity. So anyway, what I just wanted to say is, for me, I found founders that were way more grounded, certainly than in bubble days. They've learned a lot. In fact, most of the time, their response to the crisis has been exemplary. I've had discussions where we're are you sure you want to cut that deep because you might be putting product and engineering at risk, rather than the opposite, which was very often, hey, we need to cut deeper. So I found myself surprisingly having discussions on the other way around, which is, hey, let's avoid getting into a vicious spiral because we're hyper optimizing for cash. So I have to tip my cap to founders for a minute and go I've been quite impressed, honestly, by the response since 2021, at least in the people that we work with.
Really interesting. I think we could genuinely debate and talk about this and the other questions for hours, but unfortunately we're going to have to wrap it up there. Thank you so much to all of our brilliant panelists, Carmen, Saranga, Fred and Hussein. We really, really do appreciate you coming on. So to our attendees, we hope you've enjoyed the discussion, and we're now going to move on to the pitches after a bit of housekeeping. So shortly, stay on this screen and the pitches will start rolling momentarily. On the right-hand side, you'll see a link to all the companies that are pitching today, and you'll be able to request introductions through that link. And during the pitches themselves, you'll also see prompts to request introductions to each of the companies pitching. But thank you so much to you all for joining us, and we hope you enjoy the pitches.
Awesome.
Thank you, guys.
Thank you so much.
Hi, my name is Olu, founder and CEO of Foundy. We have modernized the end-to-end process for buying and selling a company. We've capitalized on one of the most lucrative yet inefficient processes in the world of finance, M&A. Foundy came about from building my last SaaS-enabled marketplace. I learned firsthand how incredibly antiquated the traditional exit and acquisition process is. Now we've emerged as Europe's leading end-to-end M&A platform for SMEs. We're serving the bottom 95% of businesses that can't access the right support, tools, and buyer network they need sell their companies. The average timeline to sell a company is nearly 12 months. On Foundy, we've repeatedly proven capable of selling companies in less than 30 days. We've got over £15 billion worth of cumulative acquisition budget amongst our 9,000 buyers. We gained more buyer budget in 1 month than the previous 11 months combined. And that's because we've got more and more high-profile acquirers coming onto the platform looking for acquisition opportunities, including private equity funds, software aggregators, mid to large corporates, all looking for their next opportunity. Despite charging 3 times lower fees than traditional advisory firms, we can hit venture scale revenue and very high profit margins because our tools, technology, and team iron out those inefficiencies, costs, and complexities with our end-to-end platform, so we can hit very significant revenue, even with a very small number of transactions. We've got a combination of recurring and upfront income. We have an expert team that have laid out the critical foundations for hyperscale growth from here on in, using strategies such as broker partner program, organic referrals, which 26% of new users are coming from word of mouth and referrals, social media content, and other key channels. We'd be delighted to welcome you on board from Focal if you wish to invest.
Door closing.
Hey, I'm Neil, and this is Coco. In 2022, $1 trillion was spent on business travel, which equated to 1% of global emissions. By 2050, these emissions are estimated to increase by an incredible factor of 5. Business leaders want to help, but they don't know how. 89% of businesses want a sustainable travel solution, but only 13% have effective travel plans in place. Despite the business travel market being so large, traveling sustainably remains challenging. It's costly, it's time-consuming, it's complex. The solution? Coco Travel, the first business travel platform that enables businesses to offset plus all their business travel impact at no extra cost. So how does it work? A customer logs on to Coco Travel platform, they then search and compare travel options, they book, and we offset 101% of the travel emissions they generate without any additional cost to our customers. Our revenue channels are flat rate trip fees, commissions, and also markups. What about the financials? Well, in our first month, May 2022, MRR was £297. Last month, it was £400,000. That's an annual run rate of £4.8 million. We also beat a unicorn. This is the first 12 months of growth for a travel tech unicorn, and this is ours. We grew 2.7 times faster. Some more impressive stats. Our LTV CAC ratio is 7.73, our burn multiple is under 1, and our CAC payback is 3 months. Who's making this happen? We are. We've got a track record of founding, scaling, and exiting businesses. We've done this before and we will do it again. The big vision. Today, net zero business travel. Tomorrow, net zero for all. We need your help getting there. Wrong. Coco will break even in roughly 140 days, 10 hours, 42 minutes, and 7 seconds. We just want to get there a little bit faster. We've got the rocket, so give us the fuel. Coco is looking for a £3 million seed round for product development, team expansion, and 18 months of runway. Don't hang around. Coco won't.
Hi, I'm Ambra, the co-founder and CEO of Juniper, and I want to share a very personal story with you. I had polycystic ovarian syndrome, a common condition that affects 1 in 8 women, and the majority of health insurance plans do not cover fertility matters or chronic conditions. So I was left £1,000 out of pocket for just a routine checkup. I then turned to public healthcare and spent 3 months all to get the wrong medication. This experience was not only costly and unexpected, but also deeply frustrating, not just for me, but for the hundreds of people we've spoken to. Given the lack of solutions, employers are taking matters into their own hands today, some contributing up to £45,000 per employee for fertility benefits. With Juniper, we want to offer an all-in-one reproductive health cover to employers. We're more than just fertility, as we focus on the overall well-being of your reproductive organs for all genders and all stages of life. Think of endometriosis, menopause, and ED. It's like dental insurance for your genitals, together with a digital platform to make healthcare easy and accessible. We are a team of 2 co-founders. I was a tech and financial services investor, and Sam, the CPTO of Juniper, was the first head of engineering at Gaia, the IVF insurance startup. He currently runs innovation at Brit Insurance. We are surrounded by a team of best-in-class advisors spanning across insurance and medicine, supporting us on every step of the journey. We are now working with forward-thinking insurers to secure licenses and capacity. We've built the foundations of our MVP, and we've also signed 1 letter of intent and closing 2 more for our pilots next year. We just started raising our pre-seed round of 1.2 million. We have some angels and advisors already committed, and we're looking to engage with institutional investors. Thank you.
Hi everyone, my name is Darren and I am the Head of Business Development here at About Energy. We are a battery data and battery modeling company that aspires to democratize data available to companies and to empower them in their electrification journey. About Energy is the product of 2 battery research powerhouses in the UK, Imperial College London and University of Birmingham. Our co-founders bring very specialized skill sets and research developed during their PhDs and from their research groups to enable About Energy to test, parameterize and model batteries very accurately. And this is a very incredibly difficult problem. This is why you see automakers pouring millions into building their own battery labs. Our deep tech IP allow customers to reduce the investment required and accelerate their time to market by providing them with the most accurate battery data and battery models. And this is very important because battery models are used throughout the battery value chain. Cell manufacturers use our models to optimize their own designs and even to benchmark their own technology against other manufacturers. System designers such as automakers, aerospace eVTOL companies, motorsports F1 teams use a variety of our models to help optimize performance around their systems. Even battery analytics companies use battery models as a foundation to help them to understand and analyze the data that they receive from electric fleets. We centralize our solution under a software platform called The Vault, where customers can have access to all the data and models they need from over 100 commercial cells. To date, we have more than 10 global customers, many of whom are multi-billion-dollar companies. The only one we are allowed to publicly announce is Porsche, but we have other German and UK automakers who are also our customers. We also count a Swedish cell manufacturer and motorsports F1 teams as our clients. We started trading in January of 22, and we are on track for more than 3x growth in 2023 revenues. We have assembled a team that has deep engineering, electrochemical, and commercial experience to help navigate the challenges of running a startup, and we look forward to continuing our incredible growth in 2024. We will be looking to open our Series A round in late Q1 next year, and we are looking for strategic investors with deep connections in the automotive and cell manufacturing space. Thank you.
We are facing a $600 billion network intrusion pandemic. And this problem is costing us a lot of money, and it's only getting worse. And despite living in the era of artificial intelligence, it still takes over 200 days to identify an attack. And existing vendors are still using outdated techniques from the 1930s. And the best way to identify network intrusion is by looking at data over time. The problem is existing workflows are just not fully automated. And that's why we built NeoCortex, which is a time series search engine applied to metrics observability. Automatically finds and ranks anomalies, correlates the trends 24/7, and then responds to it with an LLM agent. NeoCortex is a digital mRNA vaccine. Once we find one anomaly, we can sequence it using a proprietary neural network and find all correlations automatically with AI. And NeoCortex is built upon the world's fastest time series search engine. NeoCortex turns metrics monitoring into an AI search problem. And this is a groundbreaking idea. We are technical founders currently in the Pioneer Accelerator with experience in machine learning, blockchain fraud analytics, and quant finance. The story behind our discovery is a fascinating one, and we'll love to tell you more. The metrics monitoring space is huge and growing and spans cross industries. We are now looking to raise a pre-seed to take our proprietary search engine and iterate upon our SaaS. And lastly, we just came out stealth and we're super excited to be launching this at Focal. If you're a company at risk, contact us and get your free digital vaccine today.
Hi, I'm Nicolas, founder and CEO of Frame. Today, we live in a hyper-fragmented work environment. Enterprises are using between 150 to 250 applications at the same time to operate. Your employees constantly have to switch between multiple tabs, multi-application, many times a day. Your business data is widespread and structured in all of these different applications, making it difficult for you as a business to be ready for AI and get business insights. Sometimes business don't even have access to that knowledge. Your employees are losing about 10% of their productivity time by constantly having to switch focus. That's why we created Frame. Frame is a new operating system that's lightweight, minimal, and fast. It consists initially on 5 apps: Notes, Tasks, Whiteboard, Goals, Wiki. Each of these applications offer a unified work experience. You can co-create documents in real time with your team. You can easily refer documents from one application to another, and each of the applications is minimal, going back to the core of what you need. Our vision down the line is to augment this suite with 5 additional applications, as well as AI agents, think like AI product managers or AI operation managers that will be able to augment your employees and perform tasks on a native application, as well as third-party apps. We believe we can monetize our suite up to $50 per user per month, through a combination of license for our core apps, as well as AI insights and the marketplace for third-party apps. Our ambitious vision is backed by Episode 1, Kleiner Perkins and Bonfire Ventures. We also have the privilege to work with world-class advisors like the CTO of Intercom, the head of infrastructure at Coda, and the VP growth at Amplitude. Since opening our beta early June, we've seen the number of workspaces doubling every month over the last 4 months, coming from 150 workspaces early June to 1,500 workspaces today. We've seen excited businesses getting started on Frame, like Linear or Stoic, as well as more mature enterprise like NVIDIA, Dell, or Stripe. If you're as excited as us to create the next Microsoft, we'll be happy to partner with you on the next seed round. Don't forget to get started on Frame at frame.so.
Globally, 10% of CO2 emissions come from heating and cooling buildings. But it doesn't have to be this way. If we seal a building's heat leaks and upgrade our energy systems, this number can be 0. But how are we going to know where heat loss is happening, or how much it's going to cost to fix it, or once whether we've installed insulation, that it's actually working? I'm Lucy Lyons, the CEO and co-founder of Kestrix, and we are using mass thermal image capture and AI to map how heat leaks from buildings, informing retrofit planning, pricing, and verification at city scale. We're starting by working with UK social housing providers who are under immense regulatory pressure to retrofit their buildings. We've been going for just under a year, but we have multiple paid customer pilots, including with the largest social housing provider in the UK. We've raised $500K in equity financing from top operators, environmental economists, and VCs, as well as $240K in Innovate UK grant funding. We believe we've got a truly awesome team to scale this. As the CEO of Kestrix, I'm a two-time founder with direct experience commercializing sustainability SaaS products, as well as degrees in urban planning and sustainability. My co-founder, Matt, comes from 20 years of high-tech product leadership experience, 10 of which were at Google. Even better, he grew up with his parents renovating homes around him and has an advanced degree in computer vision. We're supported by excellent advisors at Kestrix from organizations such as Arup, the Retrofit Policymaking Division of the Welsh Government, and the University of Oxford. We're really excited to meet seed stage investors investing in prop tech and sustainability in advance of our seed round in the first half of 2024. Thank you.
I'm Anthony Fletcher and I'm the founder of Believe in Science. But before that, I was a scientist at Oxford and Princeton before joining an early stage Innocent Drinks. I then joined the 7 founders of Graze. They ended up making me the CEO before we sold the business first to the Carlyle Group and then later to the global consumer giants Unilever. Third time round the block, there are 2 things I believe. One, there really is just a limit to how much the consumer can change their food habits. The other thing I believe is that science really can change the food industry and we're just at the tip of the iceberg in terms of reformulating those unhealthy products. We're targeting the sweet bakery market. It's almost as big as the global dairy market, but it has something very unusual about it. Less than 1% of it currently is making any attempt to be healthier. Our donuts, they're not just a little bit healthier, they are much healthier. We've removed large amounts of the bad stuff and in blind third-party taste tests, they taste as good as a Krispy Kreme donut. The key is to understand scientifically what is going on in all of these foods, and we've used in-house R&D, partnerships with academia to do this and then develop patents, novel processes in our own in-house factory. We're expanding by placing cabinets into Tesco's and Sainsbury's stores. Just 75 of these cabinets can generate nearly £1.5 million worth of sales. Just rolling out into the 2 customers we've got into their top quarter of stores, that's a £30 million business. As we scale up, our gross profit is trending steadily upwards. We're looking to extend the last round to fund this next stage of local distribution. Expanding around London and the South East takes us to around £10 million worth of sales, which is break-even economics. We want to perfect the supply chain ahead of rolling out nationally, which is about £100 to £150 million worth of sales. We've got some great backers, including some of the country's leading venture capitalists, but we've also got people who have a real stake in this obesity debate. Come and join us, and let's prove for the first time anywhere in the world that there can be a healthier segment in sweet bakery.
There's a growing number of businesses each and every day, and the way that they handle their accounting and tax is fundamentally broken. Hi, I'm Dan, co-founder of Ember, and we exist to solve this problem once and for all. Currently, business owners have one of 2 ways in which they can handle their accounting and tax. The first is they enlist the support of an old school accountant, which comes alongside massively opaque pricing structures, super slow response times, leading to the ultimate disempowerment of the business owner. The second is that they can enlist the support of an old school accounting software, such as a Xero, Sage, QuickBooks, built and designed specifically for the accountant. Taxes are a pain in the but they don't have to be. Our tax-first smart software gives businesses total visibility from day one on what all of their obligations are, when they're due, and how much they need to pay. The ability to speak to professional accountants on a live chat is transformative, providing certainty on their own business specifics and saving money through tax optimizations. And the final piece of the puzzle, a direct connection into HMRC, allowing our business owners to go from bank transaction all the way through to tax submission without ever leaving the platform. We're now driving £1.3 million in annually recurring revenue, supporting thousands of micro-limited companies and sole traders across the UK, with gross margins of 75% and net revenue retention above 100%. Having just signed a monumental deal that will see Ember provide an embedded tax solution to hundreds of thousands of business owners with the UK's largest business bank and 3 follow-on partners within the banking ecosystem, we're now raising to supercharge the launch of our embedded tax solution and aim to be within every single bank by 2026, ahead of the major making tax digital legislation changes. Come and join us on our mission to liberate these business owners from financial admin once and for all.
We are Fixed Construction, and we exist to solve one of the biggest real-world problems, the skilled labour shortage in the construction industry. Hi, I'm Henrik. I'm one of the co-founders of Fixed. I've spent the last 8 years working in construction. During that time, I've seen how hard it is for companies to find vetted skilled workers and for skilled workers to find companies. This is due to the fluctuating need for specialised skills at various stages of a project. And because of this, a large proportion of the industry are self-employed temporary workers that have no pension, no insurance, and no holidays, and can be let go at a moment's notice. Companies and workers have no way of knowing what's out there, so both have to rely on their personal networks or traditional agencies. This results in a high turnover and poor matching, resulting in more time and money spent on the hiring process. So earlier this year, I teamed up with Lucy and Des to start working on a solution.
In the 4 months since we raised our pre-seed, we've built 2 separate products, one facing companies and one facing workers. Both are designed to tap into existing behaviours in the industry. To attract workers, we created the largest aggregator of construction jobs in the UK. This has led to a surge in sign-ups, including a growing number of organic referrals. Our proprietary matching system connects companies with skilled vetted workers. The matching and the vetting is just the beginning though. It allows us to collect the data we need in order to start building supply.
In construction recruitment alone, we have a £5 billion per year revenue opportunity in the UK. This becomes 67 billion if we look at Europe, and 810 billion globally. Where are we today? We've already started working with our first customers and are revenue generating with 30k of GMV last month. In terms of fundraising, we're already backed by some awesome investors, and we're not raising right now, but we will be raising our seed fundraise next year. So if you're keen to connect and learn more ahead of that, please get in touch. Thank you.
Hi, I'm Chris, founder of FlowStack, the AI observability platform for teams, not just developers. About a year ago, we built one of the first AI plugins for Google Sheets that quickly grew to tens of thousands of users, which also came with a rapidly growing list of scalability problems. At the time, there weren't any tools to help figure out why these problems were happening, so we hacked together an internal tool to understand these issues, which then went on to inform dozens of new features and fix countless bugs, often before they were ever reported by our users. That tool, now called FlowStack, also helped us refine our pricing models with real-world data and proved invaluable in troubleshooting problems alongside our customers on the fly. From these first-hand experiences and from talking to other teams building AI products, we realized that observability shouldn't only be for developers. It should be accessible by everyone in the company, including product teams and customer success. FlowStack tracks AI-specific metrics such as requests and model costs, metadata, and derived metrics such as average cost per user, all of which can be easily sorted, filtered, and searched in real time. FlowStack also handles optimizations such as remote caching and rate limits with API endpoints for developers to tap into. Monitoring these models will soon become as essential as Google Analytics is for websites. And while we're focused on LLMs for now, we're looking at multimodal monitoring for the future. We've raised £400,000 in pre-seed and are looking for another 400k to go to market with our pivot, as well as nail distribution and pricing. EIS is available. We're 2 weeks from public release, so be sure to sign up for our waitlist for early access and check out the demo on our website. A big thanks to Focal for featuring us, and feel free to reach out if you have any questions. Thanks for your time.
This is Carly, and I'm the co-founder of Hello Clean. We create shower essentials for better skin, hair, and health. If your skin and hair felt different on holiday or acted out after a recent move, the culprit lies in your shower. Over 60% of the UK and 85% of the US struggles with hard water. It ruins the hair and skin, causing dryness, sensitivity, to even severe symptoms such as eczema and hair loss. So we created solutions that tackled the root of the problem by becoming the one-stop shop that addresses all of your hard water struggles.
Hello everyone, this is Omar. I'm the co-founder of Hello Clean. Today we are at 10 million run rate and on track to hit £7 million revenue in 2023. That's a 600% increase from last year. Our positive cash flow and 80% margin ensures we don't have a runway issue and it fuels our continuous growth. Our numbers are impressive, but it's even more important how we grew. HelloClean has been 100% bootstrapped from day one. We have a very lean team to fuel sustainable and profitable growth. We are raising £5 million to accelerate our growth in international markets and into retail. We aim to hit 30 million revenue in 2 years.
You can find us in retailers such as Cult Beauty and Selfridges, ranked amongst the top 5 best-selling indie brands. We were also featured on BBC Dragon's Den earlier this year, where we received offers from 3 dragons. We're on a mission to get everyone to rethink how their beauty and wellness routine begins. We hope you can join us on this journey.
Hi everyone, I'm Alex, co-founder and CEO of Sentify, a product analytics platform for LLM-powered products. Let me tell you a bit more about what we do and the problems we're solving. The proliferation and adoption of LLMs across several industries is fundamentally changing the way businesses interact with their customers. It is a 10x technology that is disrupting many markets across various use cases. However, as the interaction becomes more contextual, traditional web analytics no longer offer the critical visibility organizations need to really understand the customer needs and sentiment. Organizations are offering improved conversational interface experiences across their support, marketplace, or content generation summarization services. However, they're still flying blind on what customers actually are asking for and what results or answers they get back in return. This results in negative customer experiences, lost revenue, and churn. How is Sentify helping solve that problem? Sentify's mission is to help organizations harness the power of generative AI by gaining deeper insights into the user's interaction conversations with their LLM-powered products. Whether this is a chatbot, a virtual assistant copilot, or a content generation lab, we provide in-depth cohort and user conversion behavioral pattern analysis and give businesses visibility on their customers' real needs and experiences with their products. Although we're still early on in our journey, and the technology is still relatively in its nascent stages of adoption, we see increased interest across startups and large organizations. We are currently onboarding design partners to our MVP and targeting a full product launch in January 2024. And a bit about the team. We're 3 co-founder friends with complementary backgrounds across engineering, data science, business management, and software sales. Our combined experience in high growth pre to post-IPO tech companies have given us the unique exposure to how companies build, ship, and grow successful products, communities, and customer solutions globally. We have raised 1.1 million from 2 great investors, episode 1 and 500 emerging Europe, with the participation of some incredible angels. Our next milestone is to complete our design partner phase and raise a seed round 12 months from now to scale our product and sales. Thank you very much.
Hi, I'm Glenn Waters, Head of Early Stage Banking here at HSBC Innovation Banking.
And I'm Divya Krana, Vice President working alongside Glenn, specialising in consumer-focused startups and angel fundraising.
As you may have seen, there has been a lot going on since we last spoke to you. We've had the rebrand in July, announced by the Prime Minister during London Tech Week. And since then, we have transitioned to HSBC platforms and are continuing to support clients.
At HSBC Innovation Banking, we have the privilege of working with talented founders, supporting them on their journey from the earliest pre-seed stages all the way through to IPO and beyond. Our commitment to nurturing the next wave of innovators is why we're excited about our collaboration with Vocal. We've been lucky to see several clients of ours join Vocal, who have gone on to attract top investors and achieve scale.
As Vocal continues its impressive journey, dedicated to simplifying the fundraising process by connecting founders and investors efficiently, we're delighted to stand by their side as partners. It has also been great to see the continuation of the diverse pool of applicants, with over 50% of the 1,900 applicants coming from underrepresented founders. We truly believe the partnership between Vocal and HSBC Innovation Banking can continue to be the catalyst for something greater.
In the midst of unparalleled advancements in technology and science, how can we accept that cancer is still taking 10 million lives every year? Well, at OncoDecision, we don't. My name is Mert. I am the co-founder of precision oncology startup OncoDecision. Precision oncology, which is using genomic profiling to detect actionable mutations in cancer tumor, is at the heart of cancer research. However, its benefits have been limited. Only 27% of cancer patients are eligible, and fewer show limited response. At OncoDecision, our vision is to make cancer a manageable disease with the power of precision oncology and artificial intelligence. To realize this vision, we are developing bioinformatics and machine learning algorithms to understand therapeutic vulnerabilities. Our algorithms identify signatures that can, 1, inform combination therapies for cancer patients to increase survival rates in the form of precision oncology reports, and 2, assist in the design of new cancer drugs. Our technology relies on groundbreaking research called REFLECT, which was published and presented in American Cancer Research Conference last year. The technology has 2 significant differentiating factors. 1, it uses multi-omics data, including RNA and proteomic profiling, instead of relying only DNA sequencing. And 2, it identifies recurrent co-alterations instead of monomutations to inform combination therapies for cancer patients instead of single therapies. REFLECT technology was developed by my co-founder, Zeynep, and our Chief Scientific Advisor, Anil, who are both from MD Anderson Cancer Center. We are currently raising our pre-seed funding to enable us launch our first product, Precision Oncology Report, in the next 18 months. Join us in this meaningful journey.
Hey everyone, my name is Sam Desi, and I'm the co-founder and CEO of Pop AI, an end-to-end AI co-pilot for enterprise recruitment teams. Prior to Pop, I left a budding career in surgery to retrain as a data scientist in Cambridge, after which I joined the Department of Health as the head of emerging technology. During that time, it was the very beginning of COVID, and we were scaling up our ops rapidly. And this involved hiring hundreds of people every single month and processing tens of thousands of applications. I saw firsthand how the hiring process broke down at scale, from high quality, high touch human-led hiring to low quality, low touch automation. It became clear that the most effective tool in hiring is us, human intuition. But human intuition simply isn't scalable. And that's why today's products focus on replacing human intuition with one-size-fits-all machine intuition. But that is simply replacing one problem with another. And that's why we're building our own proprietary technology that sits on top of large language models that allows recruiters to program exactly how they think and work into an ever-improving digital assistant that is able to deeply analyze and have thousands of screening conversations with candidates simultaneously. We started building Pop AI just 4 months ago, and 2 months later, we shipped a very primitive version of our product. Since then, we've onboarded 5 paying customers. One of them is the largest social care recruiter in the UK, and we're in pricing negotiations with a $24 billion global enterprise. We have a long way to go and a lot to build before we can realize our vision. And that's why we're raising £1 million, which will enable us to scale to over 80 customers and 1.5 million ARR over 18 months. We now have offers totaling over 60% of our raise from both institutional and angel investors, and we really look forward to getting acquainted with some of you too. Thanks so much for listening, and have a wonderful day.
Hi, I'm Gülşah, the CEO and co-founder of Queen AI. Applications of AI are booming. However, making AI reliable, simple to implement, and affordable is the North Star. We have cracked this with a revolutionary deep learning platform for behavior prediction. We started our journey with e-commerce, where changing industry dynamics, savvy customers, and regulations are restricting data availability. Advertising is now less targeted and more expensive, and 97% of visitors are abandoning their journey. This is a big problem, and if e-commerce companies keep doing what they are doing, they will get the same results. Imagine being with the visitors in real time, understanding their stories, and predict their privacy. Queen is the first no-code, end-to-end automated deep learning platform to manage and predict the online behavior in a privacy-safe mode. The leading brands who use Queen are proof of the incredible results. Our product development continues with the vision of democratizing AI by developing generative AI for behavior prediction. Our journey has started with leading brands, is backed by UKTN for AI innovation, and will expand to the whole e-commerce ecosystem through technology partnerships. Demand has been validated with leading brands, and we will reach over 2 million revenue with a strong trial to conversion success. We are two sisters and co-founders, along with a team of innovation specialists who have experience in leading global companies. I'm responsible from innovative business, and Gonca is responsible from the technology with her 20+ years of experience in AI. We are now raising £1.5 million for our key hires and technology to foster our growth and innovation. We have 2/3 of the round committed and would like to connect to investors who want to join us to be the part of our vision. Thank you.
Hey, I'm Tash Grossman, founder and CEO at Slip, and we're building the future of shopper data by actually making digital receipts work. In today's evolving world, customers aren't talking about omnichannel. We're not going into shops and talking about our online and offline experiences. We're just shopping with our favourite retailers and brands and expecting a consistent experience regardless of the channel. But these omnichannel experiences that we're craving are data-driven. Retailers have to know who we are when we're in their physical stores, which represent 70% of retail transactions. So today, they're missing a large chunk of omnichannel visibility. Existing solutions are not working. In fact, me losing my receipt in Zara led me to starting Slip, and who really enjoys standing at the till and reciting their embarrassing email address from the 90s. Meet Slip, the omnichannel data platform and digital receipt solution that actually works. For customers, it's so simple. Signing up to Slip takes less than a minute, and then whenever you're shopping in a Slip-enabled merchant, all you do is present your Slip code. That's it. You receive an itemized receipt storing everything you're buying all in one place. But for retailers, it's so much more. We're finally capturing that in-store customer data, creating enriched insights around customer spend and buying habits, and really giving them a single view of the customer. Digital receipts are no new concept, and we're not pretending we're the only people trying to solve this problem either, but our team's unique experience, passion, and industry backing and expertise makes us the right people to create this new standard. 18 months ago, Slip was a well-thought-out idea. 6 months ago, we launched into retailers, and now we're ready to take it to the next level. We've already delivered thousands of receipts, offers, awards, won industry recognitions, attracted enterprise clients, and we're just getting started. Today, we're raising our seed round with over 60% already committed. So please get in touch if you'd like to learn more about our ambition and why we're the team to create the paperless future. Thank you.
Hi, I'm Martin, co-founder and CEO of Supplyful, the most advanced platforms to help entrepreneurs to launch and operate scalable skincare, supplement, or packaged food brands with one click. After selling our first e-commerce business in the US, we wanted to create a supplement brand, but we encountered tons of problems. We spent months to find the right partners, invested tons of money in inventory, and we had to find 3PL distribution partners to deliver the products to end customers. And all this came with a massive risk because we don't know whether the products are going to sell or not. So we thought there must be a much better way to do this. So we created Supplyful, a platform where entrepreneurs can easily source high-quality products, brand them with their own labels, and start selling online. When they make a sale, products are prepared, packed, and shipped on demand on their behalf to their end customers. Entrepreneurs pay us only when they make a sale. and our team has been killing it. We launched 2 years ago in the US market and have already shipped out more than 130,000 items, generated 3.5 million in net revenue, and are steadily growing 20% month over month. And in August, we hit profit. We're on track to hit 6 million in revenue this year, which will be 6 times more than what we generated the previous year. Our team of 30 people is world-class, highly efficient, and incredibly motivated. We have previous experience bootstrapping our first e-com brand, graphomap.com, in the US market. We successfully grew it from 0 to 1.5 million in revenue and sold it in 2020. We have been our customers, so we know exactly what we need to build to ensure that they succeed with their own brands. And our customers absolutely love our solution. Now we're raising 10 million Series A to 10x our revenue in 2024 to 60 million. We will achieve this by opening more CPG product verticals, deploy multiple AI products, and add all the biggest e-com platforms as sales channels. So join our journey to fundamentally change the way new consumer packaged goods are launched and operated in the US market and beyond. And remember, the biggest winners are the ones that are selling shovels during a gold rush.
Hey there, it's Rich, co-founder and CEO. If you think that was fast, get ready for the change that open banking and generative AI will bring to finance. We believe that the UK's 5 million entrepreneurs should experience the benefits first. In fact, by the end of this demo day, there will be over 170 new businesses launched across the country. Those doers, dreamers, and go-getters are building our economy, the jobs we need, and ultimately our future. There are no weekends off for them, yet they are typically neglected from complex financial services. Ask the entrepreneurs that you know about their struggle getting a mortgage. Our private bank solves this by unbundling the investment, savings, and mortgage services usually reserved for the most wealthy founders, and we are making them accessible to entrepreneurs from day zero. More excitingly, we are able to put this on autopilot, enabled by recent technological and regulatory advances. We have self-funded this mission to date. Now we have market pull for our platform we are raising. Due to interest in our round here and in the US, we are increasing our raise to 10 million. We are taking first round meetings with new investors next week. We want to get back to serving entrepreneurs as soon as possible. And so for efficiency, we are only taking meetings with mission-driven fund partners that have experience in fintech or consumer. We will be prioritizing warm introductions. Thank you.
Hi, I'm Carly, co-founder and CEO of Yoni Health. The fintech market is estimated to be worth $1 trillion by 2027. Yet 1.6 billion people suffer from a gynecological condition for which there's no adequate cause, diagnosis, or treatment available. With women still being excluded from the majority of clinical trials, we have found a non-invasive way to study the female physiology through periods. An unhygienic waste that hosts over 800 unique proteins not found in systemic blood. And while we bank urine, spit, blood, and even sperm, scientists have yet to find a way to bank periods. Until now. Our specially developed technology will enable women to send us their periods from the comfort of their own home. And this is why we are pioneering Europe's first period biobank. With access to an undiscovered, high-demand resource, We will leverage business and researchers and build the most extensive database and become a one-stop shop for female biometrics, biomarkers, and stem cells. Our team consists of industry-leading specialists with strong background in the science, diagnostics, and technology fields from the likes of Unilever, Freshfields, and Telefonica. I'm a multi-award-winning professional with over 15 years experience managing complex projects worth billions. While my co-founder Emma is an award-winning entrepreneur with over a decade experience in the science and tech field. We are raising £1 million pre-seed with interest already from various funds and investors. So join us in revolutionizing the healthcare industry.
Hi everyone, I'm Aurora, CEO and co-founder of Zephy, product team's AI copilot. Product management today is broken because product teams spend most of their time in low added value activities and they have no time to focus on what really matters. Guess what? The product. Their stakeholders and information are scattered across tools, and this creates inefficiency and misalignment. It's a cost for the companies and a pain for the PMs, and a huge missed opportunity for both of them. By tailoring our proprietary technology to each company's specific knowledge, we can streamline the entire product development process. From discovery to prioritization, understanding which feature could bring the biggest impact for your company, into initiative, ticket generation, and stakeholders alignment, and more. So Zephy gives the product team a tool to easily align the stakeholders and information scattered across tools, and to the stakeholder, the rest of the company, a tool to stay up to date to the product team's activities. Building the wrong feature is expensive. It's a missed opportunity in terms of time, resources, market share. Zephy understands the customers and the company strategy, with combining it with revenues and product data. So it gives the product manager an instrument to prioritize, to unleash creativity and innovate for impact. It's an ecosystem of deep learning technology condensed in a copilot. Since we launched, we gather interest from all around the world. We are now working with amazing companies, scale-ups, unicorns, and after capturing the product team, the product market, so with the advantage of having already integrated all the data coming to all the related departments, we will become the company AI copilot. The knowledge management system market, the segment about extracting value from company data, is growing at a CAGR of 23%. And competitors are existing players with outdated infrastructure or new vertical solution. No one covers the entire product development process with Zephy's capabilities. It was built by a team of second-time founders, unicorn early employees with experience in AI and ML and, first of all, product management. But we are not alone. We are supported by amazing product leaders and many more. And together, we want to revolutionize the way product management is done. So join us to unleash product power with Zephy. Thank you.
Hi, my name is Andreas and I'm one of the two co-founders of Northbound. We are building a logistics tech B2B SaaS intake management platform for shippers and BCOs. Every company that moves products into distribution centers or factories struggles with the monitoring and execution of the inbound transports. €100,000 loss for a container that was inbounded too late. Millions of demurrage and detention fees. Horrible customer experience because of an unexpected delay. That's the reality of businesses when they get their inbound planning wrong. And they do get it wrong. Northbound puts operations teams back in control by automating their planning and execution with full awareness of their business goals and capacity constraints. Getting the intake sequence wrong results in costly disruptions, production stops, or loss of revenue. Companies respond late to exceptions, underutilize their assets, and are structurally dependent on overloaded and stressed planners. Why? Because they operate on entirely human-led manual processes that are based on email and Excel. Every company feels this in their top and bottom line. Northbound provides a common platform for all inbound shipments and connects stakeholders via one single source of truth. We reduce middle-mile transport planning to a single click and enable operators to spot and mitigate ETA changes, capacity fluctuations, or customs issues proactively. Rahul is a second-time founder and former staff engineer, and I spent 4 years at sea and operated several Amazon fulfillment centers. We are building since January and have 3 paid pilots, including one of the globally most recognized sports brands and a cooperation with DB Schenker. And now we are raising a 500k to 1 million pre-seed. Thank you for your attention.
We exist to unlock the wealth that is hidden in people's closets. There's an estimated $1 trillion worth of unworn items that are gathering dust all around the world. It remains there for 2 reasons. The first one is that most people don't know the value of the things that they have in their closet. Second reason is that it's too much hassle to sell these things. We make it stupidly easy because we recognize that you want to spend your time doing the things that you love rather than having to worry or procrastinate about those things that you should do. We have technology that can recognize and price any item from a single photograph. You take one photo and we'll match it with all the data necessary and pricing to auto list that on a marketplace for it to sell in less than 30 days. We have launched in the premium sneaker market first. We're growing month on month and will exceed 500,000 per month within a year. We're a team of experienced entrepreneurs. This is not our first rodeo. This is my 5th technology scale up, and I'm surrounded by a team of people that have spent half their lives trading on the secondary market. We're also very savvy or well versed in the machine learning that's necessary to analyze the data to deliver the results we need. We're going to start the process of a Series A fundraise early next year when we believe we're ready. We're going to raise approximately $7 to $10 million. Our current investors are Barclays Sustainable Impact Capital and Techstart Ventures.
Decarbonizing your home is expensive and complicated. Now, imagine what that feels like for portfolio owners with hundreds of properties. These companies have earmarked up to 10% of the portfolio value, that's $300 billion a year, to 2050, to these activities. And the scale of the problem is immense and often paralyzing. They could spend millions on a high-level consulting project, hundreds of thousands on a detailed engineering study per property, or just buy data from a startup with no clear use case.
So we're building Stoic because we believe it doesn't have to be this way. Stoic is the end-to-end decarbonization and renovation platform for large real estate owners, from private equity firms to developers. Stoic will finally make it easy and fast to do high ROI decarbonization.
So, what does Stoic do? Our B2B SaaS platforms helps our customers to do 2 things. First, plan. We find the highest ROI decarbonization path using public data and proprietary technology. 100 times faster and at a fraction of the cost. Second, act. We're building tools to execute the plan all in one place, from integrated supply network to financing options to all the regulatory and investor reporting. We're starting with plan to allow our customers to both create granular asset-level execution plans, optimize across the portfolio to unlock economies of scale without paying massive consulting fees, and review and manage progress against the plan, both at the portfolio and asset levels.
And you won't find a better team to build this. We've got myself, with a deep understanding of our customers' pain points as a junior partner in McKinsey's real estate and sustainability practices. Lorenzo, who understands the technical operations of our business as an aerothermal engineer and a decarbonization expert in McKinsey's energy practice. And Alexi, who knows what it takes to build some of the best products in the world, as a former founder and a product manager at Meta and Go Cardless before that. And here's the really exciting thing. We already have an LOI from a firm with over $1 billion in assets under management. We're excited to be our first customers and design partners. So, we're raising $1.5 million to hire engineers
and build the first planning tool. And we're looking forward to hearing from you.
After leading a wellness tech startup for 8 years, I became dog dad to Rio. I realized pets can't tell you how they feel, so taking care of them is mostly guesswork, leaving most preventable conditions unnoticed for years. This is coupled with a pet healthcare industry that is reactive, costly and clunky and not built for today's time-starved pet parents who are looking for a quick, seamless solution. Scooch is an AI-powered personalized pet health subscription for every stage of a pet's life with a mission to take guesswork out of pet care. The subscription includes AI-powered health checkup and vet assistant, best-in-class treatments delivered to your door, and 24/7 video veterinary support. We're also on the verge of getting our FCA approval for releasing our pet insurance. We launched our MVP a year and a half ago and already achieved tremendous traction, helping thousands of pets with their health conditions. We surpassed £1 million ARR and have been growing a whopping 47% month over month with positive unit economics. We're forecasting to be profitable next year and been selected the best pet tech of 2023 by TechRound. We have an amazing founding team made up of former founders with strong experience from startups such as Motorway and Revolut. I have 23 years of business experience building and investing in tech companies, as well as working at blue chips like Unilever and Havas Worldwide. We're backed by Founders Factory and an amazing group of more than 30 founder CEOs of successful tech companies investing in us. We are raising a $3 million seed round, which is EIS eligible to launch our insurance product, grow our team, and accelerate user acquisition. This is a huge and booming market, expected to become $350 billion by 2027. We're looking for visionary investors to join us in our journey to make pet healthcare a walk in the park. Thank you.
Hey, I'm Jeet, the co-founder of Kinfolk. Most companies still don't onboard their people well enough, costing up to twice that person's salary. In fact, 1 in 4 people admitted to crying in their first week. And it's even worse for hybrid teams. So why is it so bad? Well, there are more mistakes with more manual coordination, there are more docs to get lost in, there's less visibility to know where to support someone in the moment, and it's also harder to form intentional connections. With Kinfolk, companies can design and deploy playbooks to systematically ramp up their teams in a bespoke way. Ramping up someone isn't just about automating tasks and nudges. That's why we created playbooks. Playbooks guide everyone involved with content, actions, and communications. There's also live tracking to measure knowledge uptake, collaboration, as well as time to ramp, plus rich profiles and a Slack plugin for intentional connections. So rather than juggle a bunch of these tools, people teams can plug in their tech stack and content into Kinfolk, design the right process, and then scale it and iterate on repeat. Our design partners are already creating playbooks for other repeatable ramp-up moments, like promotions, internal moves, and parental leave. And when they're not hiring, they're operationalizing best practices to level up their people in an evergreen way using our playbooks. They're converting to paying customers on annual contracts. That first invoice was paid last week, and we're getting inbound through recommendations and the waitlist as well. And our users are loving it too, and one partner is enrolling every employee into Kinfolk to reboard them on ways of working and tooling because of this feedback. We have tiered pricing based on headcount and use cases, and are tapping into a $4.7 billion revenue opportunity in the US alone. Enterprises are using HR tech like Workday and then bolstering that experience with the likes of ServiceNow to enable employees further. And we've been compared to them by HR leaders previously and believe there's a ServiceNow-shaped gap in mid-sized organizations with our playbooks as the wedge. We've been in WorkTech for over 5 years now, and Kim and I met at Beamery and together delivered AI products that led to Beamery's unicorn status. And we want to do it again. So we'll be raising our pre-seed to acquire 25 to 30 mid-sized organizations, create a product-led sales motion, and introduce Gen AI to build playbooks in minutes. And we are SEIS eligible.
%80 of everything moves via the ocean. And today, freight is stuck in the Stone Age, running on faxes, phone calls, and spreadsheets. FreightCore is the AI-powered logistics company. I'm Sam, and I'm CEO and co-founder at FreightCore. and my previous business that I founded moved thousands of containers across the world containing millions of dollars worth of goods.
And I'm Will, CTO and co-founder at FreightCor. I've been an engineer at Apple and vice president at Goldman Sachs, where I led critical infrastructure. The chair you're sitting in right now was made in China. So how did it get here? In a shipping container traveling via the ocean. The job of moving that container from China to the UK is a $1 trillion industry called freight forwarding. So what's wrong with freight forwarding? Well, it can take 4 days just to get a quote, not even including booking it. And once you have booked it and it's on the ocean, you've got no visibility of where it is in a journey that can take up to 45 days. This is because freight forwarders are notoriously inefficient. They're plagued with human bottlenecks.
Today, FreightCor offers instant quoting, 100% visibility, and being an AI-driven system, there are 0 human bottlenecks. Our vision is to move the largest amount of cargo using the smallest number of people, allowing us to scale like a software company, with our only limitation being how fast we can sell. Our longer-term vision is to automate the entire freight forwarding industry via our Freight Forwarder as a Service offering. In terms of traction, we started trading in November last year, and since then have around doubled our revenue each quarter, with Q3 at over £220,000. In Q4 of this year, we're actually going to reach net profitability. So, that being the case, why do we need the investment? Well, the answer is speed. The £2 million is going to allow us to put in place the infrastructure to scale our company to over £60 million in annual revenue and also roll out our Freight Forwarder as a Service offering. We hope that you'll join us in automating one of the largest industries that nobody has ever heard of. Thank you very much.
Hi there, my name is James and I'm the CEO and co-founder of Newmark. As a former CFO, I spotted that banks were pulling back from unsecured lending to corporate companies. I realised this was a huge hidden gap that could be exploited through innovation in digital lending. We built Newmark to fill this hidden gap. We're taking on the incumbent banks at their own game, and we're winning market share in an industry worth $3 trillion in the UK and Europe alone. Newmark is the only digital credit platform transforming working capital management for mid-market corporates. Through our SaaS platform, customers can access a dedicated unsecured credit line, which can be used for making all their corporate payments, using credit cards or paying invoices. After onboarding, customers can immediately draw on their multi-currency credit line. The intuitive interface allows them to instantly manage users, amend limits, set payment rules, and allocate credit to make their corporate payments in any currency, all in one place. Corporates can benefit from extended credit terms, and CFOs benefit from complete real-time visibility into their corporate spending behavior, i.e., who is spending what, where, when, why, and how. Powered by Athena, our AI-driven credit engine, Newmark is able to underwrite the credit risk of its customers in near real time, continually processing thousands of data points and predicting customer future cash flows. This enables us to offer dynamic credit, that is, credit that flexes to the customer's working capital needs, whilst limiting the downside risk and monetizing the upside. Our platform is completely revolutionary. It's an all-in-one solution which provides certainty of liquidity to meet the cash flow needs of a business, and it streamlines the payments process for users and budget holders. Because of this, customers are incredibly sticky, and we're able to rapidly grow wallet share. Just the other day, we had a customer transfer all their US dollar Amex spend onto our platform. That was worth $300,000 of spend each month. Our research shows that mid-sized businesses rely on unsecured credit for almost 50% of their working capital requirements. This is the opportunity Newmark will fill. So what's the opportunity for you? Well, you can invest in our seed rounds that we are opening now. We are proven and our traction is undeniable. With a team of just 3, we've been growing at more than 30% per month this year. With our fundraise of £5 million, we will get to profitability in 18 months with an ARR of £7 million. So join our journey now to make Newmark a credit powerhouse and the leading working capital solution for corporates in the UK, Europe, and beyond. Thank you.
Hi, my name is Marcus, and I'm the founder of Bandit. Having worked with global consumer brands for years, I keep on being shocked by the unfair pricing in the value chain. In short, consumers will spend 6 trillion euros when shopping online this year. Only 10% will be sold directly from producers, which means that 90% of online sales globally will go through middlemen, each taking their cut. As a result, 63% or 3.8 trillion euros will be given away to middlemen just moving the goods, which means that producers get only 1/3 of the money you pay. Here's our solution. Meet Bandit, a platform where you get unbeatable deals by buying directly from producers in groups. Our vision is to power direct-to-consumer sales from most producers on Earth. In the Bandit app, consumers discover unbeatable deals on the products they already love and share the hottest ones with their friends to together group up, meet the volumes producers expect, and unlock unbeatable deals together. It's a win-win situation for both producers and consumers. We launched beta 4 months ago, and early metrics have exceeded all our expectations so far. We're growing fast in our pilot market, just exceeded 20,000 app downloads, growing exponentially and mainly organically. We have a high net promoter score where most of the users joining Bandit come purely from personal invites. Users are highly engaged as they interact with the Bandit app 8 times a month. Also, we've started testing out paid ads and we've seen a high conversion rate where the paid marketing CAC is only 2 euros for a new user who downloads the app, registers, and places the order. This shows that the market has embraced Bandit, preparing a great foundation for further scale and growth. We're now raising our seed round to power direct-to-consumer sales from producers all around Europe while making shopping online truly social and fun. Join the Bandit mission to reclaim the power back to producers and consumers, just the way it should be.
Hello, my name is Tunde. I'm the co-founder and CEO of BridgeCard. BridgeCard is the card issuer for Africa. We make it easy for fintech companies to issue their customers a card that will carry a Visa logo and work anywhere in the world. We have a lot of bank tech experience on the team. Before BridgeCard, I was building open banking APIs to help fintech companies connect to the large banks across Africa. When I decided to do this, I also had to turn down a job from Google to build BridgeCard. My co-founder Festus is also our CTO. We've been friends for over 15 years now. He's done fintech all his life. He built the retail and loan application at TradeDepot. TradeDepot is the Salesforce for Africa, and they're also a Series C company. He also worked at NordCredit in South Africa and also Keeper. A couple of years back, we built the machine learning model that helped Access Bank give out loans to artisans like plumbers and carpenters that do not have a regular flow of income. In the last 4 months, we've grown our revenue by over 507%. We currently make $85,000 in monthly recurrent revenue, and that puts us at over $1 million in ARR. This is the right time to build BridgeCard because payments across African countries have largely been solved by mobile money initiatives like M-Pesa. But payments between African countries and the rest of the world is largely broken. Your Nigerian card will most likely not work in Cameroon or Ghana, that's just like the next door neighbor of Nigeria. Africans are also beginning to consume global services like never before. Take for instance, 1 gigabyte of data is now 75% cheaper than it was 5 years ago. And so Africans now consume global services like Netflix, Amazon. Developers now pay for developer tools. Small businesses also shop from AliExpress and Alibaba to come down here to Nigeria to resell. Most times, the large bank cards do not work for these payments due to scarcity of FX. BridgeCard brings the perfect mix of crypto for on-ramp and off-ramp exchange of currency and also card issuing so that fintech companies do not have to bother about managing the bank relationship or sourcing FX when they want to issue cards to their customers. We can get them to go live in 5 days. By targeting 200 million middle-class Africans in Nigeria, Kenya, Ghana, and Uganda, we're estimating that they will spend an average of $100 monthly on our card. We make about $5 per user per active card in a month. This estimates our market opportunity at $16.8 billion. We're raising $4 million in our seed extension round, and we have the round led by Y Combinator. This round is going to help us grow our revenue to over $250,000 in the next 18 months, and also acquire a PSSP license here in Nigeria and expand to more African countries so that we can serve beyond the 20 African countries we serve now.
And that's the end of the pitches. Thank you to the founders who've done an incredible job of putting together their videos. We can't wait to see how all of the startups get on after demo day. We'll be sending a form to all attendees later on today to gather interest, but attendees can also visit gofocal.vc/intro to request intros to the founders. We'll then be inviting you to invest alongside us in some of the most promising startups of 2023. Please do remember that capital will be at risk, and you'll need to head to gofocal.vc/SPV to be added to our SPV comms.
I think that's all from us for now, so a big thank you to our finalists, everyone who applied, everyone who's watching, to HSBC Innovation Banking and our other sponsors, Google Cloud, Mishcon Daraya, BDO, Rippling and Stripe, to our partner VCs, and to all of you who really make this all possible. Now, don't forget to head over to the session rooms by clicking on the button on the left-hand side of the screen. We have lots of cool stuff planned for 2024, starting with Focal Deploy. So keep your eyes peeled and see you at our next demo day in May.
Yeah, go on.
Wait, what are we doing?
We'll just do a mixture.
We're doing, what are we doing? Fist bump.